Greeting of today. This is Muhammad Shakir Ibrahimi, a lecturer of investment and portfolio analysis or management we have. Today we'll discuss about the third session that we have about this subject. So what is actually we cover till now, what is investment, what is portfolio analysis, and how to measure different risks. If you are going back to the last session, in the last session what we discussed actually, this is what just giving review. In the last session we discussed about what is risk, what is the example that how to find expected risk, and we are trying to find out the risk, which is variance analysis we had. So to measure the relativeness or relative expected return, rate of return that we have. So this is what we discussed with the help of example. In today's session I will be talking about two main important topic for the session, that is standard deviation and relative risk measurement. So what is standard deviation? The standard deviation, it is the square root of variance that we have, that we can calculate, that we had variance was equal to summation of probability multiplied by return minus expected return square, and then we are finding the total of that we will get variances. So now what is standard deviation? Standard deviation is the square root of that, so we can calculate it. So what actually mean standard deviation that we have in this session, that we will get to know what is actually meant by standard deviation. Standard deviation, it measures the risk of investment which fluctuated from the expected return. So we are analyzing, we are measuring the risk which we are investing our money in the organization. So what is the expected return for that? So that is what we are gonna calculate in the coming slides. So what mean actually by standard deviation? So if our standard deviation is lower, it means there is low volatility and there is risk less. So it means that project is not risky. But when the standard deviation is large, so it means the return is high, so the risk is high. So this investment that you are doing, that is risky investment. So riskier investment that we are having it. So this is what we are need to know about the standard deviation, that what is actually standard deviation, right? So this is the formula for standard deviation, which I said that probability summation standard deviation is equal to the under root of variance, as we can say. Variance, that means, so this is what I want to write down. So the standard deviation is equal to, so this is D, right? Standard deviation is equal to under root of variances, right? So this is what we are having, a standard deviation. So if I want to calculate the standard deviation for the above example, so this is the formula which is giving to me here, right? So formula is giving to us, that is what is the formula for standard deviation: probability multiplied by R minus expected rate of return. So this is the formula that we have. So how to calculate standard deviation, right? So I will try to make it here, that how we should calculate standard deviation. In the slide I will try to make a table that you will get to know how to calculate standard deviation for it, right? So if I'm writing, just making formula, I'm clearing this area. So we say that formula for the expected return. So what is the formula we discussed in the last session? Yes, expected return is equal to what? Probability multiplied by the rate of return, right? So here is the formula which we did in the last session. See, this is the formula: probability return divided by return. So probability multiplied by rate of return, right? So this is the formula that I have here to make it, right? So how to calculate expected return? So I will calculate expected return is equal to expected return is equal to expected return, I can say, or I just change color, that my expected return equal to probability. So what is probability of first one? 0.15 multiplied by 0.20, right? So 0.15 multiplied by 0.20 plus, right? The next one, which is average, 0.15 multiplied by minus 0.20 plus the next one, 0.70 multiply by 0.70 multiply by 0.10. So this is what we got it, right? So how we will get the expected return? So the expected return will be equal to around 0.07, right? So that is what we got, the result at the end, that what is my expected return that I have here, right? Now what we have to find out? We have to find out variances. That is what we have. Formula: probability multiply by return minus expected return square it, right? So square root. So this is the formula that we need to calculate these things with the help of this formula. So if I want to calculate variance, so it is equal to how much? So the first one, probability is how much? Start bracket 0.15 multiply by multiply by bracket start return. So what is my return? 0.20 minus expected return 0.07 square root, right? Close the bracket plus, right? So the next one which I want to find out, start bracket 0.15 multiply by return is minus 0.20 minus 0.07 square root, close the bracket, plus next one, return 0.07 multiply by return 0.10 minus 0.07 square root, and then will be equal to how much? So if I will let you know that we calculate the variance for that question which I rightly did is equal to 0.014 is equal to 0.014, right? So this is how we will get the result of variances which we have. So what is the standard deviation for that, right? So standard deviation is equal to what? Under root of variance. So I can write down variance, or I simply I will do it in the while here in through pen. So if I will get to solve my standard deviation for this, so standard deviation is equal to what? Under root of what? Variances. So we got here the variance result. So what is my variance? Answer, it is become 0.0141. So this is the answer. So you will get standard deviation. So what is equal to my standard deviation? So standard deviation is become 11.87%. So it is become 11.87%. my standard deviation become how much? .8 7%. So this is my standard deviation which I got it here. So the risk is how much? So I have the risk of 11.87% and the returns which I have. So on these returns I have this much risk for this investment at different situations. So this is what you gonna compare the standard deviation. Next one is relative measurement of risk. So how to measure to risk? What is the purpose of this measurement, which is, so we are using coefficient of variance for the purpose that when we are having unadjusted variance or standard deviation, so it means that we cannot adjust, it may give you wrong decision, so that will may have a misleading in that situations. So if you have two or more than two investment that are not similar to take your decision, that you have to calculate to what is the major expected return rate of return for that. So for that purpose we are gonna to calculate that coefficient of variance. So in the coefficient of variance you will measure that what is the expected return per unit based on the risk which you have. So for that formula we have expected return, coefficient of variance is equal to standard deviation divided by expected return, right? So what is my standard deviation here? Standard deviation is 11.87. So I will write down my coefficient, which is symbol is here, equal to standard deviation. So it is 11.87% divided by how much? My expected return is how much? 0.07, right? So it is 0.07 which I have. So from this you will get to know how to measure the relative risk, which is clear cut is given. So that is which we have 0.07, that is into percentage, not into percentage, into numbers. So I have to calculate the above also, that is 11.84%. So I will write down 0.1187, right? So you will get what? Coefficient. So what is my coefficient here? So if I will do division for these both, 0.1187 divided by 0.07, so it has become 1.69. So my coefficient is 1.696, right? So that is why, what is my coefficient? So what do you mean by this coefficient that which I have? By this means that the measure of relative variable risk by the financial analysis compare the alternative investment with wildly different rate of return and division. So here we got that this is the risk that we have, this is expected return for each unit. So based on that we calculated here how to calculate standard deviation. So that is one aspect for the one investment I had. So we are using relative measurement risk for two, to compare which of them are better for our organization and which of them are not good for our companies or organizations. So here again we will calculate a standard, what we are representing this CV, right? So I am writing CV, coefficient of variance, equal to what? Standard deviation divided by expected return, right? So what is my standard deviation for the first one? Is 0.05 divided by the expected return for the first one, 0.07. So you will equal to how much? The second one, which is CV of B project, this is CV of A project. So again in formula the same, we have standard deviation of 0.07 divided by 0.12, 0.12, right? So how much it will be equal to? If we want to calculate the coefficient for the first one, so how to calculate? So 0.05 divided by 0.07, it will be equal to 0.71. 714, right? So this is the first answer. The second answer will become like we have 0.07 divided by 0.12, 0.58. So it is equal to 5.8%, and that will be equal to 7.14%. I think the first one is which we calculate 0.05 divided by 0.0177, so 70%. So here you will take decision for the investment, that portfolio that we have different investment A and also B. So on which projects you want to invest, on which projects you want to make the investment. So for that purpose we need it. So here you will take decision. If you are gonna to take decision in the first one, so the expected return is 0.7 and the risk is 0.5, but in the next instance the risk is 0.07, but my return is 0.12, so that is higher. So now how to compare that, which project is better for you? So based on this coefficient of variance, so you will get to know about this. So in case of you have any query questions, so you can contact me or ask me through YouTube channel. Thank you so much for your attention. Wish you all the best. Thank you.